why you think consumer confidence moved higher as much as it did in the month of October.
Well, it's been trending down for the last 3 months, and the Conference Board's latest consumer confidence index ticked back up. And it's almost, Tyler, a barometer of what we're seeing with the Delta variant. When things were starting to look bad, confidence went down. And I think in the short term, it's going to be a barometer of where COVID is and where the variants are. But the inflation numbers here were the big surprise. And this is a 13-year high in expectations for inflation. That's a big number here, and people are a little concerned about where prices are going and where wages are going. Now, if you look at the Conference Board's CEO confidence index, it was the same thing. They're really worried about inflation and their ability to deal with the wage increases and the labor shortages and so forth. But finally, the important thing here is that despite the increases in costs, consumers are not talking about ratcheting back their spending. So we're seeing their intention to buy homes and cars and washing machines and everything else still going to be there, and the demand's going to be there for the holidays. So the good news is it's not damping demand at this point.
So let me just make sure I didn't get something incorrect in the intro. I said that the overall consumer number was at a 13-year high. Is that true, or is it merely that?
It's the inflation number that's at a 13-year high. The consumer confidence index is at it's a high number, but it's not a 13-year high. But it's
I thought so. When you mentioned the inflation number being at a 13-year high, my little alarm went off, and I said, well, it can't be both of them. That just is too peculiar. But let's, Jim, let's turn to what Steve mentioned there, and that is that consumers, while they are mentioning concern about inflation more than at any time in 13 years, they are also not apparently restraining their intent to buy or their spending. Why is that? Is it because their balance sheets are better? Because they've saved more through the pandemic and done and spent less? Why?
Yeah, I think so, Tyler. There's no doubt they're worried about inflation and watching prices go up in the grocery store and at the pump. But let's face it, we're looking at a job market. I think in the same report today, the survey of jobs plentiful minus jobs hard to get, it went to an all-time record high in the survey. That's just one example. They're seeing wage hikes. They're seeing other potential job opportunities. As you mentioned, they got a 9% savings rate, in the past year, probably double what it's been historically. Their balance sheets are about as good as they've been in my career of 37 years, Tyler. Debt to income among the household sectors at one of the lowest levels since 1995. It's been improving since 2008. Debt service ratios are the lowest they've recorded since the early 1980s. They got $18 trillion sitting in bank deposit accounts. That's up from $13 trillion just at the end of 2019. So they've got a lot of borrowing capacity. They've got awful good job market and income and savings trends. I think there's a lot to be optimistic about.
Jim, so let's translate this back to the market then. Do you basically think that we're going to continue to see nominal spending increase? In other words, the price of everything is going up, including GDP, including the stock market.
I think so, Kelly. I think that we're going to slow down next year in real growth terms and probably in inflation too eventually. But we're talking probably growing 6% real GDP this year, maybe 4.5% next year. Even at 4%, that's probably higher than most of the time in the last 2-3 decades in this country. So it's going to feel pretty good on Main Street. One thing I would point out in the report, they survey every month. They calculate among the consumers how many bulls there are and how many bears. That ratio fell to just 4.1 or 2, something like that, just barely positive. There's just a few more bulls than bears. It's lower than about 2/3 of the time since 1988. And it's interesting to me because usually when the stock market's at a new high, that bull-bear ratio would also be close to highs, as it was in 2000 or 2007 or even 2018, 2020. Here we've got a below-average confidence ratio about the stock market where consumers are relatively confident overall. Tells me there's still a less of a FOMO among households about the stock market than there is a phobia, that is fear of being in the stock market. They're still fearful of this market going down.